Hi all, welcome to this tutorial. In this tutorial, we are going to cover the market ratios. The market ratio, as we know, the market ratios are the ratios which is connecting company stock price or the market price with the books of account. So, two parts are there. First one is the company's books of account and the share market or stock market. So, in the market ratios, which is connecting company's books of account with the stock market to see its investment potential, expected return, future prospect, etc. Market ratios, also known as valuation ratios, are critical tool used by investors and analysts to assess a company's stock value related to its earnings, book value, or cash flow. So it is comparing either a company's stock price with its earning, book value, or cash flow. The market ratios will help the investors to assess whether the stock is undervalued or overvalued or fairly priced and to make various informed investment decisions. So the market ratios, which is comparing a company's market price with its books of account to see whether this share is overvalued, undervalued, or it's fairly valued. Again, this analysis help the investors or potential investors to make various informed investment decisions, like to sell a stock, to buy a stock, or to hold a stock. This analysis will help, or market ratio analysis will help the investors to make various analysis and to make various decisions. So the first ratio is book value per share. Book value per share, the name itself, it is selling what is it. So the book value per share, it is considering how much the actual book value per share. As we know, the stock market and book value can be vary in many cases. Maybe, for example, a stock is telling at a, or selling or trading in the stock market at $100. Maybe its book value can be vary from 100, maybe it can be 110, or it can be below 100, or maybe 50, 30, even 40, even 10, even 5, depending on the its market performance. So the book value per share help the investors or the analyst to assess and to compare what is the book value per share and to compare that with the market value per share. So how we will calculate the book value per share? Book value per share, that is total shareholders equity, that we have to distribute the total shareholders equity to number of common outstanding shares. Even from the common equity shares, we have to reduce the preferred equity because it consider only the common shareholders equity. Suppose, just look into this case. In this case, the total shareholders equity is 10 million, and even that 10 million, there is a 500,000 preferred equity. So in this case, how we will calculate the book value per share? So this 10 million is belongs to common equity shareholders outstanding or total equity shareholders. From the 10 million, 500,000 belongs to preferred equity. So from the 10 million, we have to give 500,000 to common shareholders equity. That means 9,500,000 is the shareholders equity or common shareholders equity that is available to common shareholders. So this we have to distribute with the number of common shares. In this case, there is 1 million common shares. So it is 9.5. So in this case, the book value per share is 9.5, which indicates that every one equity share, the company have equivalent $9.5 of shareholders equity in the company. Again, book value per share represents the theoretical dollar amount per share that common shareholders will receive if the companies were liquidated. Meaning all assets were sold at the balance sheet value and all debt were paid off. It reflects the accounting value of a company's equity as per share basis. So the total equity it is allocating to common shareholders to see what is the share book value per share. Again, before we are allocating, we have to separate the preferred equity separate because preferred equities will not consider as a common equity. So in this book value per share, it is considered only the common equity. And from the total equity shareholders, it is deducting preferred equity, and the remaining amount is allocating to common number of common outstanding shares. So that case you will get the book value per share. So let's move to next concept, that is market to book ratio. Market to book ratio, it is just a comparison. What is the market price per share? What is book value per share? Again, this comparison will help the investors or the potential investors to assess whether this investment or this shares is underpriced or overpriced or it is fairly priced. So the market to book value book ratio analysis will help the investors to assess whether this share is overpriced, underpriced, or fairly priced. And they can make various informed investment decisions, including whether to sell the stock or to buy the stock, or if it is fairly priced, they can hold the stock. For the market to book value ratio, it is comparing current market price per share divided by book value per share. Just look into a case. If a market price per share is $500 and book value, just assume it is $250. So what it indicates that you have to buy this share if you want to hold this share, or if you want to keep this share in your portfolio. You have to spend $500. But if in the case if the company is liquidated, the actual book value per share is $250 only. So here what is the interpretation here? Normally, a ratio greater than 1 suggests the market view of a company future earning power, like intangible, like brand value, growth prospect, as a greater than the accounting value. So normally, if the market value is higher than book value, which indicate that the market is viewing this company's future earning power than its book value. In this case, you can see that the actual book value is 250,000 only, but in the market it is selling at 500, which indicate that this share is, or the potential, or the investors, or the market view is assessing its future earning power or future earning potential, and it is valuing the market price of the share as 500. So normally, which is considered as a positive sign, because is this company have a future potential and market already given that future potential to the share. That's why this company is overpriced, or the ratio is greater than 1. There is a negative side also. It can be due to some speculation effect also. So before investing into share, we cannot just decide based on the market to book value. Maybe the price increase due to the inflation or the speculation factors also a factor to the to ratio can be greater than 1. If the ratio is less than 1, it indicates that stock may be undervalued, or that the market has negative outlook on a company's asset or future earning. Let's look into other case. If the market price is 250 and its book value is, just assume it is 300. So in this case, what we can do, then ratio will be less than 1. So what it indicate that two options are there. First, in the market stock might be undervalued in the market. So if it is undervalued, that is a great investment opportunity. Or there shall be some negative outlook on the company's asset or future earning in the earning. That's why the investors are not willing to pay its book value to the share. So even before interpreting the market to book value ratio, we have to consider different scenarios or different approach, whether this overvalued or undervalued due to any speculation effect or its company reputation. This has to be considered before deciding any investment decision or before making any investment decision. So again, the market to book value ratio is just a comparison of what is your market price and what is your book ratio. If the ratio is greater than 1, which indicate that the market price is greater than its book value, which can be both. Maybe one effect can be it is overpriced, or it is have future potential earnings. So that may the investors are willing to pay that amount to that share. Again, if the ratio is less than 1, which indicate that stock is undervalued, this can be one indication. If it is undervalued, that is a great investment opportunity, or there are other possibilities also in this case. Maybe there is a negative outlook in the company's assets or future earning in the market. So let's move into the next concept, that is basic earning per share. The name itself is mentioning what it is earning per share. Earning per share means what is the earning or how much the company is earning per share. That means it is allocating the net income available to common equity shareholders with the weighted average common share outstanding. You can see the formula here. The basic EPS measure the portion of a company's profit allocated to each individual share of a common stock currently outstanding. It is the most straightforward measure of corporate profitability on a per share basis. So the basic earning per share, which is allocating or which is comparing net income available to equity shareholders with the number of outstanding shares. For example, just a simple example, if you have a net profit available to equity shareholders is 5 million and you have 1 million shares, which means that you are earning $5 per share. So that means this net income available to equity shareholders is allocating to number of outstanding shares. So you can see the formula here, net income minus preferred dividend. Again, the preferred dividend has to be removed from the net income to see the earning per share or basic earning per share, because normally we are considering earning per share only to common equity shareholders. Again, after we are dividing that with the weighted average common shares outstanding. Again, a higher EPS generally indicate greater value. It's the denominator used in the PE ratio. A higher ratio means higher earning per share is always indicating a positive sign because the company is earning more value on its shares or its common share outstanding. So just is in this example, a net income is 5 million and preferred dividend is 0. There is no preferred dividend in this case. Then the weighted average shares outstanding 1 million. So the basic EPS is 5 per share, which means this company is earning $5 per all common equity shareholders. It's outstanding or weighted average shares outstanding. Then let's move to next concept, that is diluted earning per share. So normally it seems that there is a confusion between earning per share and diluted earning per share. Diluted earning per share is very straightforward. It is dividing or it is considering total net income available to common equity shareholders and it is allocating to actual number of common shares outstanding or weighted average number of common shares outstanding. Actual weighted average common shares outstanding. But in the diluted earning per share, it is considering the probable dilution also. Suppose in some cases the company might have some dilution, possible dilutions in the future. For example, there are some stock option, warrant or convertible debt that can be convertible into equity shareholders in the future. This is not converted, that can be converted. It may convert or it may not be converted. So in the diluted earning per share, when we are calculating weighted average common shares outstanding or weighted average common shares outstanding, we are adding potential common shares also into the equation. So here you can see the formula, weighted average common shares outstanding plus potential common shares also we are considering into formula. So that means even this shares is not converted, again it is considering that dilution effect. This is one of the most confusing for most of the students. Even if the dilution is not executed, still the potential common shares outstanding, it is also it will consider into the equation. That means suppose there is one company have outstanding shares of 100,000, just assume, and the same company have a dilutable preferred stock of 5,000. So in the diluted earning per share calculation, the total number of outstanding will be we will add this both, that is 100,000, 100,000, 105,000. This is 105,000. So we are adding this 100 plus 5, that is 105,000. Even at the time of calculation, this dilution or this conversion not happen again. Even if it is not happened again, it will consider into diluted earning per share. So diluted earning per share is a critical metric because it's a worst case EPS scenario for common equity shareholders. The basic earning per share, it is showing the actual expected earning per share, but the diluted earning per share, it is showing worst case. If the all conversion happen, what will be your earning per share? It is always, or it is normally less than the or equal to basic earning per share. In most of the cases, if there is any dilution effect, it will be less than the basic earning per share, or it is always equal to basic earning per share, because it will consider, in this case, the weighted average number of common shares will be normally higher in diluted earning per share calculation. So this is about diluted earning per share. Diluted earning per share is similar to basic earning per share, but it is also considering the potential common shares also into the equation. Again, this is showing the worst case EPS scenario for common equity shareholders if the all conversion or all dilution happen into equity shareholders. And let's move to next concept, that is price earning ratio. Price earning ratio, the name itself, it is telling what is it is. It is comparing the price of a share with the earning of the share. What is the price of a particular share and what is the earning of that share? Price earning ratio is most widely used valuation metrics. It expresses the relationship between stock's price and its earning per share. It is essentially tell investor how many dollars they must invest to receive $1 of company's actual earning. So the current market price, for example, this is telling how many dollars they have to invest to receive $1 of company's annual earning. Again, it is comparing company's market price per share with the earning or diluted earning per share. The higher P/E ratio. Normally, higher P/E ratio mean the market price of a stock is higher than and the earning per share is lower. In this case, there might be higher P/E ratio. It is suggests that investors expect high future earning growth or the stock is overvalued. If it is a high P/E ratio is higher, which indicate that two indication we have to deeply analyze before making an investment decision, because there are two chances are there if the P/E ratio is higher. The first one is investors expecting more future return. That's why the investors are willing to pay more for the stocks, or the stock is overvalued. There are due to maybe some speculation effect. Even if it is low P/E ratio suggests that slow growth expectation or the stock is undervalued, which means this company, if the P/E ratio is lower, which indicate that the one case the stock can be undervalued or the company is facing some high risk. That's why the investors are not willing to pay big amount or big investment or big amount for the share. So just look into the example. There is a example, that is the current market price per share is $75 and diluted EPS is 4.55. So in this case, the P/E ratio is 16.48, which indicate that the investors are normally willing to pay $16.48 for every $1 of earning that the company generate. That means to get every $1 of this company's earning, the investors are willing to pay $16.48, which is measuring or which is analyzing in the P/E ratio or price to earning ratio. So let's move into next concept, that is price to EBITDA ratio. Again, price to EBITDA ratio, it is comparing a market price of a share or market price of the investment with the earning before interest and tax, depreciation and amortization. So in this case, so here there is a different formula to calculate the EBITDA ratio, because in this case we cannot directly take the uh, share price from the market, because it is considering the debt, interest and everything. So this formula has to be in a different way. So the formula is market capitalization, that means the total market value of the common shares outstanding, plus the total debt, that also an investment, plus the minority interest. Is there any minority interest to any relative parties in this company, that also considers. Then we have to minus cash and cash equivalent from this, and that we are comparing with the earning before interest and tax, depreciation and amortization. So the interpretation, it measures the company's value or its enterprise value related to its operating cash flow or EBITDA. A lower EBITDA is generally considered cheaper and a higher one more expensive. So again, it is too industry independent. Normally, a lower price to EBITDA ratio, that means the price is lower and the EBITDA is higher, that means the market price is cheaper. It is considered the market price is cheaper. But if it is higher one, that means the market price is higher, then it is considered as the more expensive. Again, this we cannot directly decide whether this stock is cheaper or it is expensive. This can be vary from industry to industry depending on its benchmarking. Let's move to next concept, that is earnings yield. Earning is it is almost similar to P ratio, or it is inverse of P ratio. P ratio is considering how many times of the company's earning that the investors are willing to pay as the share price. But in the earning yield, it is the same thing. It is deciding, or it is expressing as a percentage. So that means it is comparing earning per share. Just assume the earning per share is 10 and the market price per share is 100. Then the earning yield is 10%, which means this company is earning 10% of its market price as earning available to equity shareholders. So you can see the formula here. Diluted earning per share divided by current market price per share into 100. So let's move into next concept, that is dividend yield. Dividend yield, it is comparing the annual dividend per share divided by market price per share. Then the dividend yield is how much the companies receive, how much the investors will receive as dividend when compared to market price. That means if one investor is expecting a dividend as his return, then he must look into dividend yield. That means dividend yield mean, just assume if a company is paying dividend as $100 and its share price is, just assume, $1,500. So in this case, these investors can assess that if I invested $1,500 in this stock, I can get annually $100 as dividend. So the dividend yield ratio, it is comparing the annual dividend per the market price per share to see how much percentage the dividend the investors can expect as dividend with related to their investment. Again, it is primarily relevant for income focused investors. If an investor is solely focusing on the dividend, then it is very relevant for this dividend yield ratio is very relevant for that is investment or that investor, because this is the annual dividend or annual income. Dividend is the annual income that the investors can expect from this investment. If one investor is looking into the dividend, then the dividend yield ratio, then he have to compare what is the expected dividend with the market price per share to see whether this he can generate enough dividend to cover cover the investment cost or to cover its expenses. So the formula here you can see the annual dividend per share divided by current market price per share. Again, it represents the cash or non-cash return from dividend. A high dividend yield can be attractive but should be scrutinized to ensure the company can sustain the payout. Normally, high dividend yield can be attractive, but how much the company can sustain the same dividend yield ratio is another question. So, before making normally an investment decision, then investors will always look into the dividend yield sustainability also, or how sustainable this dividend also. So, let's move into next ratio, that is dividend payout ratio. Dividend payout ratio is simple. It is based on the earnings, how much the company is paying as the dividend. So the formula is annual dividend per share divided by earning per share. So just assume if a company paid $2 as dividend and the company earned $10 as dividend. So in this case it is 20%. What is telling that compared to earning or compared to its earning per share, how much the company is paying as dividend per share. Normally, a low payout ratio suggests that the company is retaining more earning for the growth. Again, a high payout ratio suggests mature companies returning more cash to shareholders. A ratio over 100 is generally unsustainable, indicate the company is paying out more than its earn. Normally, a low payout ratio is that means the company is earning the as a profit, but it is retaining its profit into business for future expansion. If the high payout ratio, in the case of high payout ratio, it suggests that the company's expansion already matured and it is returning more cash to its investor or common equity shareholders. Again, if the company is paying annual dividend more than its earning, it may not be sustainable and it's indicating that the company is paying more than what it is earning. You can see an example here. In this example, annual dividend per share is 1.5 and diluted earning per share is 4.5, which indicates that this company is earning 4.55 and this company is paying 1.5. So that means 33%. So in this case, the dividend payout ratio is 33%, which indicates that compared to its earning or earning per share, how much the company is paying as dividend. Then let's move to next concept, that is shareholders return. Shareholders return, which is considering all the return from an investment. If I'm an investor, I want to return in the stock market or in the stock market or share market. Normally, I have two types of return. The first one is my dividend, and the second thing is my capital appreciation. Capital appreciation means if I buy a share or if I bought a share at $100, tomorrow its price may be 110. This is capital appreciation. If I sell this share today or tomorrow, I can get 110. So this 10 will be one of my return, $10. And if this company is decided to pay a dividend of $5, again this 5 can be my return. So there are two return here. First one is capital appreciation and second one is dividend. So as we are considering, if we are calculating the total shareholders return, we have to consider these two. The first one is dividend and its capital appreciation. So here the formula is ending share price minus beginning share price plus dividend per share divided by beginning share price. So in this case, ending share price is 110. Just look into this example. This is 110 and the beginning is 100. So the capital appreciation is 10. So 10 plus 5 divided by the beginning share price, it is 100. So it is 15 divided by 100. That means 15%. So as a shareholder's total return, this share can provide 15% return for its investment. So in the shareholders return or total shareholders return, it is considering the total shareholders return, whether it is the capital appreciation or dividend. So this is about today's discussion. So let's conclude our discussion. So first, what we discussed today is the first one is book value per share. Book value per share is the name itself. It is telling what is the book value available to distribute to common equity shareholders, and it is dividing with the number of common shares outstanding to see the book value per share. And market book ratio. Market book ratio, it is comparing the market price per share and book price per share to see whether this investment is overpriced or underpriced, and to make various financial investment decisions. Then the basic earning per share. Basic earning per share mean how much a company is earning per share, per basic share, and diluted earning per share. Again, it is how much a company is earning per share. Again, here when we are calculating the total number of outstanding share in the diluted earning per share, it is considering the potential dilution as well. Then the PE ratio. PE ratio is comparing the market price per share with the earning per share. Then the EV to EBITDA. It is comparing the enterprise value or enterprise value, that means the total investment value with the EBITDA to see whether this investment is too cheaper or it is costly. Again, this EV to EBITDA ratio is, it has to be checked or against the industry benchmark as well to make more informed decision. Then the earnings yield. Earnings yield mean diluted earning per share with the price. That means how much a company is earning with related to its market price. Then the dividend yield, again how much the company is paying dividend with related to its market price. Then the payout ratio. Payout ratio means how much company is paying dividend with related to its earning. Then the total shareholders return. Total shareholders return, it is considering the two types of return which include the capital appreciation and the dividend, and it is considering this both return and it is comparing with the total investment value to see the proportion of the shareholders return, total shareholders return. So this is about today's discussion. So if you have any doubt or you need any extra clarification on any of these topics, please ask me on the comment section. Again, I am attaching this PDF material along with this video, so you can download and use that material. Thank you for watching this video.